Hey guys, how's it going? This is Joseph Henson with Henson CPA Group, and this week we wanted to talk about cash flow. Cash flow, like I said before, is different than the profit you have in the bank, and we want to make sure people understand it. So, the first thing we're going to do is, where did the money go? Understanding your veterinary clinic's cash flow statement. Again, I'm Joseph Henson with Henson CPA Group. I'm glad you guys are listening today. I'm glad you guys email in and let me know what your thoughts are and questions you have. It really helps me figure out what you guys want to know about, and we can go on from there. So the first thing, why cash flow confuses so many clinic owners. You're profitable, but the bank balance says otherwise. You made $200,000 in profit. Why does it feel like there's never enough cash? Today, we're going to break that down so you can see what's really happening inside your financials. It's something that is extremely confusing to many people. How am I supposed to pay these bills with all this profit I have when there's truly nothing in my account? I'm showing $200,000 in profit, but I have $5,000 in my bank, $10,000, $20,000, $50,000. It doesn't matter how much. The question is, where is it going? Profit, like I said, does not equal cash flow. Profit, in the simplest terms, is what's left after the revenue minus all expenses. So when you do a quick spay and neuter, anything that is associated with that, like your hourly pay, any vet techs, the scheduling, sedation materials, stuff like that, even sutures, those are items that will affect your bottom line. So you're going to take your $100 for the service. That's low for some, high for others, just an easy number. And you're going to take out the $20 for the cost of goods and the hourly rate. Again, just easy numbers. $80 in profit. Now, cash flow is the actual movement of money in and out of your accounts. So this isn't just the money that you're seeing on the top line and bottom line. Cash flow is all the money that comes into your account and out of your account. Some items show up in one place but not the other. You can be profitable on paper and still have no cash because there's timing involved and there's other activities that matter with your profitability. So what is a cash flow statement? This is one of the three core financial statements. You have the profit and loss statement, income statement, some people know it as. You have the balance sheet, and you have the cash flow statement. When you look at management reports, these are the three most important reports you can look at outside of a few other reports you should be paying attention to. The cash flow statement is going to show you all cash inflows and outflows in a period. It can be January to December. It can be January to the end of January. It can be January through June 30th, the first half of the year. And it is going to be divided into three main sections: your operating activities, your investing activities, and your financing activities. So cash flow from operating activities. This is the day-to-day business activities. This isn't going to be interest income. This isn't going to be dividend income. This is going to be client payments. This is going to be payroll. This is vendor bills. This is rent. These are the things that it takes to operate your business. If this section is negative consistently, your core business isn't generating enough cash. And unless you're able to start generating more cash, you will not see cash in the bank very often. Cash flow from investing activities. This will relate to the buying or selling of long-term assets. Well, what's a long-term asset? It's your x-ray machine. It's your ultrasound machine. It's the exam table that you built. It's all the flooring that you put into renovating your clinic. There is a lot of items that go into it. Did you put a sign outside that cost you $5,000? That's going to be an investing activity. Did you just have to go spend $1,500 on a new ultrasound machine and wand attachment? That right there is going to be a investing activity. They will be long-term, and they don't just happen all at once. These can reduce cash in the short term, but may also help growth. If you're able to increase the amount of work you do because you've got better equipment, that is something that is huge, and it is something that could pay off long term, even though it reduces cash now. Cash flow from financing activities. This is money that you borrowed or repaid and money taken out by you as the clinic owner. So loan proceeds, loan payments, credit card use, owner distributions. With loan payments, you are going to have a few different things. You have the principal and you have the interest. You always want to make sure that you're tying those out at the end of year and not just saying, oh, well, I paid $500 on payments this year for my ultrasound machine. That's not all the income statement. A lot of that, if you have a loan on it, I should say, is going to be on the balance statement, and then you'll have the income statement. You want to watch this section closely because big draws, money that you take out as the owner, can kill cash flow. One of the things that I like to make sure is that your salary is high enough to support the lifestyle you need to live, not always want, but need. And then owner draws above that are rewards because you're the owner. You have a fine line there between paying yourself not enough and paying yourself too much. There's some other things that go into that. You need reasonable compensation. I'm not going to get into that today. If that's something that you're interested in, love to talk about it. We can do that on another live, or we can even have a one-on-one call. But today it's overly complicated for no reason. So this is an example of a profitable but cash poor business. Net income, $100,000. I like $100,000. Always easy. Cash outflows, $30,000 in loan repayments, $25,000 in equipment purchases, $40,000 in owner draws. So this is stuff that isn't necessarily hitting your income statement, but it is hitting your statement of cash flows. So when you look at that, you're like, well, that $40,000 doesn't hit the income statement. That is something that is balance sheet related. And to do a reconciliation for cash flow, we have to take that into account. That immediately dropped any income from $100,000 to $60,000. You purchased equipment. You didn't take out a loan. That took your $60,000 down to $35,000. That never hit the income statement. You now are repaying a loan that is on the books. That took another $30,000. You went from $100,000 in income down to 60 with your owner draw, down to 35 with your equipment purchases, and down to $5,000 with the repayment on your loans. All of that without touching your net income. The bank balance tells a very different story than the profit line. If you're still running your business off what's available in the bank, we need to change that. We need to see what we can do to show you the entire picture, because your bank is just one snapshot. It's not the entire picture. We need to see the entire landscape of your business from A to Z, from your income statement to your cash flow to your balance sheet. How to start understanding your cash flow. One of the things you need to do is look at your statement of cash flows monthly, even from QuickBooks Online. That's one of the things. If you go to report, you can see it under management reports, you can see it under other reports, but look at your statement of cash flows. Track cash in and out over time, especially large infrequent outflows. If you as the owner all of a sudden are having expenses, periodically, like, hey, I need $10,000, and you just write yourself a check, great, you're the owner. You have that ability as long as the income is there and as long as the cash flow is there and people aren't suffering. You want to make sure that you can track those. So all of a sudden, you don't get to the end of the year, you're like, well, hold up, I made $100,000, but I have $10,000 in the bank and I'm being told I owe $30,000 in taxes. That's a problem. That's not something you want to do. The other thing you need to look at is create a forecast. What's coming in and going out monthly? Your clinic should grow year over year unless you intentionally try not to. Now, that doesn't mean it's growing substantially. You might not see 50% growth in year 2 compared to year 1. That's not sustainable. Now, did you add another doctor? Did you add 3 more rooms that you can see patients in? Okay, let's expect higher growth. Did you raise your rates this year? No? Well, that's common, but you have to understand, while everyone else's bills are going up, so are yours. It's something you need to know. What's going to come in, what's going to go out. And that can be yearly, and that can be monthly. So what do we do for our clients? We are doing monthly and quarterly cash flow tracking. We want to make sure that you know what's happening on a monthly and quarterly basis. We don't want to get to December 31st and say, hey, you need to go buy new equipment because you have too much income on hand. Oh, you don't have any cash for that? That's an issue. Well, we need to figure out something, or you're going to get hit with a $50,000 tax bill. We don't want that. We look at cash management strategies. What is that? Well, sometimes that's stop putting everything on accounts receivable. Let's look at scratch pay. Let's look at care credit. Let's look at some of these other options that folks can utilize that reduces the risk of you not being paid. Forecasting and planning support. Your forecast goes into your overall budget, and that is a living, breathing document. It's going to dictate your growth for the year, or if you're trying to scale back, what's going to happen on that. You have to be looking at that, and we want to make sure we're supporting our clients with that. Breakdowns to show exactly where your money is going. If you're not doing your books, if you're not tracking what happens with your money, you're the blind leading the blind. You are going to struggle. It is something that will suffer with your business because you don't understand where you're spending. Hey, why all of a sudden is this insurance up 45% compared to what it normally is? Well, let's look into that. Let's see why your insurance jumped 45% this year. Okay, you had a large claim. They're saying that you're riskier. You didn't have very good system controls in place on some of your narcotics that you have in the pharmacy. Let's figure out what's going on. So up next, maximizing your veterinary clinic's cash flow. In our next live, we're going to show you how to take control of your cash by optimizing your inflows, reduce your cash stress, and build a cash cushion. I really hope you guys are there. It's something that I like this series where we talk through different types of management reports, the income statement, the balance sheet, the statement of cash flows. And I really want to make sure we're tying this all together for you. If I ever say something, you're like, hey, I don't quite understand that, feel free to shoot me an email. I'll show you my email address here soon. Me or someone on my team will always be happy to get back with you and understand that, explain a little bit better. So if you're ready to take control of your cash flow, we help veterinary clinics make sense of their money every day. If you're tired of not knowing where the cash went, we can help. You can book a discovery call at our website, www.hensoncpagroup.com. Message us on Instagram, Facebook, shoot me an email at joseph@hensoncpagroup.com. And let's just look at turning your financial confusion into financial clarity. Again, questions, drop them below, message us privately. Let's see how we can help.